Welcome back to the Global Wealth KPI YouTube channel and for week-by-week market update from 14th to the 18th of December 2020. Stocks edged higher a week ago, with all major U.S. lists hitting new unsurpassed highs. Financial upgrade hopefulness, alongside a more splendid longer-term viewpoint driven by the rollout of antibodies, keeps on supporting notion. Long-haul Treasury yields rose humbly, and oil logged its 7th consecutive week-after-week pickup. Financial information were blended, uncovering that the monetary recuperation is losing some force in the midst of rising infection cases and recharge limitations in movement. The shortcoming in retail deals and the new stoppage in occupation development hone the market's emphasis on monetary guide. Congress gives off an impression of being surrounding a concurrence on an alleviation charge worth $900 billion. We believe that the proposed financial arrangement will give the help expected to help the economy as it advances toward the opposite side of the pandemic. In our view, basics are steady of the more extended term standpoint, yet financial specialists ought to envision knocks en route given a portion of the close-term headwinds to the economy. Exercises from last week. Stocks penetrated record highs again a week ago, exchanging inside a genuinely limited reach that mirrored a blend of empowering and disillusioning components, just as the run-of-the-mill progress toward year-end occasion economic situations. Following a sensational swing this year from a profound downturn and bear market decrease to a sprouting monetary recuperation and sharp securities exchange rally, the current climate is fundamentally more balanced one. A week ago brought an area of new data that is predictable with our perspective on progressively testing current conditions countered by an undeniably inspirational viewpoint for 1 year from now and past. Here's our refreshed view dependent on what we saw a week ago. What we expect. The movement of the financial recuperation is slowing down out as flooding infection cases have induced recharge limitations and lockdowns. We don't envision a revisitation of profound recessionary conditions. However, we figure the economy will persevere through a delicate fix in mid-2021 preceding discovering its balance as the antibody is generally appropriated, introducing a more lively bounce back in the second 50% of the year. What we realized, incoming financial readings are flagging a recognizable stoppage in action. The November retail deals report a week ago demonstrated a 1.1% decrease in spending versus the earlier month, the most exceedingly terrible perusing since the bounce back started in May. The hidden drivers of this were frail retail establishment, apparel and cafe spending, counterbalanced by more grounded online retail and home-related spending. We'd note that these drivers are flagging to a greater degree a move, and a limitation, in spending versus a bigger plunge in customer well-being. Additionally, jobless cases a week ago kept on moving higher, hitting their most significant level since early September. The latest perusing of 885,000 is, luckily, still significantly in a way that is better than the pinnacle of 6.6 million cases experienced during the most noticeably awful of the downturn, April. However, we speculate work economic situations will bear a delicate fix prior to continuing a healthier pattern 1 year from now. The reality, the economy won't explore the recharged lockdown solid, yet the current headwinds ought to end up being impermanent, in our view. We figure the recuperation will encounter recharged force as we advance through 2021. What we expect. Monetary strategy upgrade will stay an incredible tailwind, with the Fed keeping rates low for an all-encompassing period. What we realized. The Fed keeps on tweaking its way to deal with financial improvement, declaring a week ago that it will tie its resource buys to monetary results versus characterized time spans. Until generous improvement in joblessness and swelling has been accomplished, the Fed will keep on purchasing more than $100 billion in resources for each month, which will keep rates low and infuse cash into the economy. The primary concern. We think the vital takeaway from a week ago's declaration is that the Fed will keep money-related arrangement settings amazingly accommodative further into this development than in earlier recuperations. Generally, markets have performed well during stages when Fed strategy is more accommodative, which we think will be the situation in 2021. What we expect. Fiscal Upgrade will add a required lift to the economy 1 year from now. We foresee a close-term bargain in Congress, which will help uphold customer spending and work economic situations throughout the following a while. What we realized, the most recent cycle of a $900 billion help bundle has flagged some ability by Congress to settle. A new proposition to separate the parts that have bipartisan help, expanded joblessness benefits, family upgrade checks, and PPP subsidizing, from what doesn't, state and neighborhood help, recommends to us that some type of an arrangement will be reached soon. The reality, with late spending and business information giving indications of stress, the desperation for a monetary guide bundle from Washington is rising. We think Boost is expected to help the economy cross the rest of the pandemic separation without sizable or all the more enduring harm to shoppers and private companies. A 1-2 combo of money-related and monetary boost will give a durable breeze at the economy's back 1 year from now, helping overcome any barrier until the immunization can introduce a more ordinary climate of financial action. We accept we are in the underlying phases of another expansionary cycle, yet the recuperation is probably going to slither and stagger before it will run. The securities exchange sitting close to record highs isn't absurd, as values are estimating in the expectation of the economy hitting even more a step 1 year from now. All things considered, with valuations at broadened levels, the pad against potential dissatisfactions is somewhat more slender, and financial specialists ought to foresee greater unpredictability as we turn the corner to 2021. That's for this week. We will see you with next week updates and thank you for watching. Subscribe this channel for more market updates.